The TSX hitting a record high today. We had some mixed markets for the U.S. Let's go to our next guest, who says diversification, of course, is key for 2026. Jack Manley, global market strategist at J.P. Morgan Asset Management, joining us now. Thanks for your time.
Of course. Thanks for having me.
Okay, let's talk about some of the air first coming back in software stocks. They were really depleted last week. Did you think last week's sell-off was overdone?
I do think it was probably at least a little bit overdone. You know, it feels like we're putting the cart in front of the horse when it comes to this AI transition. I mean, undoubtedly, artificial intelligence has the capability to, if not revolutionize, and certainly evolutionize. I don't know if that's a word, but to evolve the software capabilities of certain companies. But you are talking about a deeply entrenched industry with long-standing enterprise connections and decades, in some instances, of proven track records. That is not going to be abandoned overnight, especially when you consider that this new artificial intelligence linked program was developed in, I believe, under 2 weeks. It's not to say this thing doesn't have legs, that it doesn't have potential, but let's not get ahead of ourselves right now. Enterprise software is still a thing that's going to stick around for quite some time.
Okay, so it's not going to do the depth of the job you see some software doing right now?
Not right now, no.
Okay. What do you think about Google selling a 100-year bond? I'm still sort of wrapping my head around how it's going to work to pay for the AI build-out.
Well, I mean, that is a pretty remarkable headline. I guess it is a reflection of the fact that the balance sheets for a lot of these tech giants are just absolutely pristine. You know, when you consider that some of the biggest players in the tech space can actually borrow for less than the U.S. government, it starts to make sense why they are taking out these very long-dated debt instruments. AI is expensive. We are in the midst of what feels like a full-blown 21st century space race. And, we sort of opened up the floodgates, so to speak, last year with a little bit of leverage getting tossed into this mix. Some of those high-profile deals that were inked from some of those big hyperscalers. We are probably going to see more of this. And leverage typically is not always the best thing to see when you're looking at a market that could be considered frothy, that could be considered richly valued, that some might say is in a bubble. But when you're thinking about the leverage that's being taken out right now, again, by high-quality companies at very low rates, smoothed out over a long time, it might not be the canary in the coal mine that historically it had been.
I was going to say, investors have been a little more shy with some of the technology stocks. The shine has come off, if you will. They're off their highs. And I'm wondering if you think something like this makes them feel better about the stock or not so much.
It's hard to say. There's so many competing forces out there that are driving these AI stocks all over the place. I think it's actually helpful to maybe take a breath and zoom out a little bit, which is to say that artificial intelligence is very much here. It very much has the capability to fundamentally transform a lot of things in our lives, hopefully for the better, by the way, but just in general, a lot of things in our lives. It hasn't lived up to its potential as of right now, especially when you consider how much money is getting pumped into this space. But it will. The companies that are embarking on this extraordinary amount of capex, they have decades worth of a proven track record of innovation in a number of different industries that they either completely created or helped to revolutionize. I would not be surprised if AI is the same thing. So in a sense, don't worry too much about the headlines today or tomorrow, the choppiness that we've seen in markets over the past couple of weeks. If you are in this as a long-term investor for really anything more than the next 12 months, I think you're going to be just fine.
Okay, let's talk about global markets. Where do you see the strength coming from right now?
So I think from a global perspective, it is going to be, slow but steady economic growth. The global economy has been, I think, more durable than a lot of people anticipated, especially in the aftermath of the trade war that was kicked off last year. But at the end of the day, the U.S. equity market might have lagged most of its peers in 2025, but the U.S. economy did not. And after a relatively disappointing first quarter, it just roared back to life with 2 consecutive prints, pretty close to double the long-term average. I think that momentum is going to continue through the fourth quarter into at least the first half of this year. And so when I think about the macro outlook, I see the U.S. leading the pack, and I see AI-related capex and technology spend more broadly being probably the single most important driver of that underlying strength.
Okay, we had retail numbers out in the U.S., and they were pretty flat for the end of the year. Can you factor that in on what you see moving forward? Job numbers are expected as well, and there's weakness. We know there's weakness.
Undoubtedly, it's a tight labor market. It is not necessarily a strong labor market. We're calling it a low hire, low fire labor market. If you got a job, you're probably not losing it. If you don't have a job, it's going to be hard to get. As that translates into consumption, it all comes back to what we've long referred to, and I wish we coined this term. We didn't, but the K-shaped economy, right? This idea that if you got money right now in the United States, you probably never had more money than you do at the moment. If you don't have money right now, you're probably about as far behind as you've ever been in your lives. And the reality is that those upper income, higher wealth individuals do the overwhelming majority of the spend. A disproportionate amount of economic growth comes from those high income individuals. And while the labor market itself, to your point, may not be perfect, and the overall consumer, to your point, may not be perfect, the people that are actually moving the needle, they're benefiting from changes to the tax code. They're benefiting from high stock prices. They're benefiting from strong home equity, from relative insulation from higher interest rates. There's a lot going right with that particular subset of the American consumer that can help to propel consumption higher over the course of this year.
Jack Manley, good to have you, sir. Thanks for your time.
Thanks very much.